Now I've got these glasses, they're called True Dark. Before we start, just tell you a little bit about these. And they've got red lenses, and what happens is apparently they help us sleep better. So I got them today, I ordered from the States, so I look forward to trying them out. Anyway, so how do we find areas that are going to go up in value? How do we find capital growth? You know, there's lots of different methods to do it, but I really think there's a bit of a science and an art to it, and you've got to get the science right. And once you get the science right, if you do it enough times, it becomes an art. So for example, I've been doing this for 20 years. So when I look at the stats, the numbers come alive, and I can see what's going on, and I can see if things are going to go up or things are going to go down through the stats, and that's just through doing it over and over and over again. I think the more times you do something, the more unconscious competent you become. Because when you first start, you're consciously incompetent, you don't know what you're doing. Then you study and learn and you become consciously competent. And then when you learn really well, you become unconsciously competent. And that's when you become a master. You know what I mean? And that's where you want to be when you're at the top of your game, no matter what you're doing. And that's where I'm at with property, because I'm unconsciously competent with that sort of stuff. But I still, regardless, I like to look at the numbers and make sure and look at those numbers and make sure that I'm right and do it. And obviously, I don't know if I'm right until I look at them. So, what are we looking at? Well, first, we're looking at a thing called DSR, demand to supply ratio. Very, very important. If you learn economics at school, you heard about demand supply ratio. So what happens is, let's say someone opens a store and they're selling widgets. Why are they always selling widgets? Let's say they're selling iPhones, right? Because Apple do this really well. Anyway, so what happens with iPhones? They only make a certain amount of iPhones when they release them. So you've got people lining up, sleeping in the streets to line up to buy an iPhone. And then what happens after day one? They will sell out. Everyone's got FOMO because they've missed out, they're upset. And what do? They can't wait to get the iPhone. They create more desire. So when there's more demand supply, that's what happens. And a lot of companies artificially create that with that. You know, it's a bit like diamonds. I mean, there's a lot of diamonds in the world, but the companies that mine the diamonds, they control how many they send out. And because of that, we pay a huge premium to get diamonds. Because if they just released them all, they'd be dirt cheap and they wouldn't be worth so much. And so that's interesting. So demand supply ratio. So what creates more demand, more supply? That's the interesting thing, you know what I mean? Like, why is it that one suburb's got a lot more demand and then supply and the other one's got less? Well, one is if a suburb's got lack of supply, that goes a lot towards creating more demand, right? But it's not as simple as that. So you can get a suburb that's near the city, near the center of the city, and because it's near the center of the city, there won't be much vacant land left. So that's got a natural short supply of stock, of properties. But what happens is, as councils change plans, what happens is you can do more properties per block, and therefore that pushes the property price up. So that's a very natural thing to happen. So if you go buy in a mining town or a boom town in the middle of nowhere, right? The demand supply ratio doesn't last very long. So, you know, you go to a mining town and there's a bit of a boom, and because there's a lack of supply for a brief moment. And what happens is people come in, they start buying, and they go, oh my God, I can't believe how much rent I'm getting. Bought a house for 400 grand, getting $1,000 rent, a week rent. When you're getting astronomical rent, something's wrong. You know what I mean? I always, go for around 5.5 average gross rent when I'm buying a property before I add any value to it. And if that suburb's doing more than that, a lot more than that, or a lot less than that, I'm not interested. And for a lot of reasons, because if you're getting a huge return on your investment, that means the higher return, the bigger the risk, right? So if you buy a property and you're getting 10, 15% return, it's risky. Just like with any investment, you only get a bigger return with a bigger risk. And really, I'm not into risky stuff. It's not worth it. So, you go out in the middle of nowhere, you can buy in a country town, and get 10, 15%. But the problem is that the value of the property going to go up? No, it's not. Probably not. And there's some towns that just disappear after a while, especially one-horse towns that are dependent on mining or one industry or something like that, or for the highway to go through, and then suddenly they change the highway and then it's gone. So demand supply is an interesting thing. And some demand supply is market sentiment. And how do you measure market sentiment, right? Well, this is the important part, because market sentiment plays a massive role when it comes to property. And a lot of people don't realize that. but it's very, very, very important. So when people are feeling good about the economy, they're feeling good about their jobs, they're feeling positive, they're feeling good about a suburb, they're going to spend more, a lot more, really. And that's why you get these hip little places that used to be really shit in the cities, and they start becoming hip, and they get these cool cafes where you sit on crates, and big people with big beards serve you, cafe lattes with almond lattes and having your smashed avocado, and suddenly the prices go up in that area, and it gets gentrified. And what happens, the poor people go, forget this, they move out, all the hipsters move in and get these little loft apartments and spend money on, have cafe lattes and do almond, get their almond lattes and get on the internet and make their money on the internet, whatever they do, hang around cafes. So, the hip score is important. So there's different scores, community score, hip score, and you can actually get these online. And what I'm going to do is I'm going to post this in the group, in the Positive Property Club. If you're watching, I'm going to post it here. And if you're looking at it from a different channel, come to my Positive Property Club. It's in Facebook, called the Positive Property Club. It's about to change names, so I better warn you. It's becoming Property Secrets. And the reason being is we're going to reveal a lot of property secrets, and we're launching a new program called Property Secrets. So that's why we're going to change the name from Positive Property Club, but at the moment that's what it's called. So come in, check it out. I'm going to put it in the notes. Yeah, so there's about 10 different factors when it comes to community score and livability and walkability. All those things matter because that's what attracts quality people. Right? So being far out of town in the middle of nowhere, and if it's a lower socioeconomic area and there's the high crime rate, that's not good for demand-supply ratio because people don't want to go there, right? So demand-supply ratio is very, very, very important. Now, how do we find demand-supply ratio? Well, there's 29 different little things that you need to look at that all add up to demand-supply ratio. And I'm not going to get more here tonight because I don't want to bore you, but basically what happens is we look at, I'll give you a few examples, vacancy rate. Vacancy rate means how many houses are vacant at this point in time in this area. And basically, if you're in an area that's less than 3% vacancy rate, that's good. More than 3% vacancy rate, it's bad. And if you've got like a 10 or 12 vacancy rate, get the hell out of there because no one wants to live there. It's really bad. And this is what people don't get. And it frustrates me when I hear people wanting to get a bargain when they get a property. Look, you make money when you buy a property, not when you sell a property, because people make money out of accumulation, not speculation, all right? So if you speculate and you want to make $1 million overnight or make a lot of money quickly in property, you might get lucky, but it's gambling. It's not smart. It's stupid. Don't do it. What you really want to do is you want a sound strategy, and you want to follow a sound strategy and take your time and follow the principles, because when you follow the principles and you accumulate property and wait long enough, that's where you make money. See, a lot of people get that wrong. They think they're going to make money in the first year or two. Sometimes you don't. Sometimes you do. But the thing is, because you can't predict the short term, you can't predict what's going to happen in 12 months. Very hard. But 10 years, very easy to predict. That's why with the weather, we can't know what's going to happen next week, but we know the average temperature next year, if you get what I'm saying. That's similar to property prices. We know the average of what's going to happen because property prices, they double every 7, 10, 12, 15 years, right? So long term, that's what happens. And if we've had a bit of we haven't had anything happen like that for a while. And if you've seen recently in the papers, they've been saying that, Brisbane's going to go up 19%, 20% over the next 3 years or whatever. And I believe it's going to do better than that. Definitely going to do better than that. And that's because if you look at the past history, and I've got a whole webinar on this. You can go on our website, Positive Property Solution. Go on our website. I've got a webinar that shows you what happened in Sydney, in Melbourne and Brisbane over the last 30, 40 years. And basically it shows you, Sydney goes boop, then Melbourne goes boop, and then Brisbane. And they just follow a pattern. And you can see there's a big gap in the pattern right now. And that pattern, I think, will be filled. History doesn't necessarily repeat, but it certainly rhymes. That's what Mark Twain said, and it's true. So what happens is we look at what happened in the past and we can tell what's happening in the future. And if you look at what happened in Australia in the 70s, we had a massive influx of immigration. Because of that, we had a lot of property growth, heaps. I mean, if you bought 10 properties in the 70s, what would you be worth now? I mean, you're buying properties in the 70s for $5,000 to $10,000, $15,000 each. So, and now those properties are worth 500, a million, 2 million, $3 million. Like, it's a lot of money. So it's crazy when you think about it. But the thing is, I mean, 90% of self-made millionaires made it through property. It's for a reason. So you've got demand-supply ratio. So therefore, you don't want a lot of, an area with a lot of vacant land. But you can have an area with a little bit of vacant land, but still have a high demand because no one's selling that land, and because the market, people are just, the market sentiment's big and they want to live in the area, and it pushes it up anyway. So you've got to look at the numbers, because the numbers show you what the market sentiment is, right? And you should never go out there looking for a bargain and trying to buy at the bottom of the market and buy an area where people don't want to be, because you're only getting vendor discount usually in crap suburbs. In a really good suburb, it's a lot rarer because people are all bidding for it and really want that property. So you got to pay a fair price. So I'm not saying overpay, because I'd never ever suggest overpay. I always believed in paying the correct value, or even slightly under if you can get away with it, but never ever overpay. And that's the big problem where people overpay for property. They go on realestate.com and Domain and find a property at full retail and overpay and go crazy, or the agent gets them all scared. I know a couple that recently bought a property about 2 years ago, and they showed me the property, and they're good friends of mine, so I'm not going to mention their name, but I said to them, what do you put an offer in? Because this area, there's not a lot of demand, no one else is going to buy the property, it's going to sit there, right? They loved it, and that was great. And I said, don't worry, you're going to get it, I can tell, because there's not a lot of demand. But the real estate agent scared them into thinking there was a lot of scarcity, and actually made them pay more than what the price they were asking, and they paid it because they were scared they're going to miss out. And it worked on them. And look, if you're scared you're going to miss out on property, what do? That's why you shouldn't be emotional when you buy property. You should really be cool and just look at the numbers, you know what I mean? And when I bought my place on the beach, I felt that myself, even though I'm a professional property investor. The agent was saying to me, someone else going to buy this property, and really put a lot of pressure, and it was very hard to get that fine line on how hard you want to play in regards to what you're going to do. So I got a substantial saving, which was great, but I didn't go right down because I didn't want to miss out. And that was one of those things, because where I was buying was very rare. There wasn't a lot of demand, but there was no supply, so it was still hard. And I'm glad I bought it, because the property has gone up nearly $1 million now, which is pretty cool. So I'm happy with that. But it was an owner-occupied. I wasn't actually primarily buying it to make money. I was buying because I wanted to live here, and it's a beautiful house. It's fantastic, but comes in handy when even your owner-occupier makes you money. Because your owner-occupier, according to Robert Kiyosaki, is not investment. And in actual fact, it's not, but it is. It doesn't make you money, but it helps you with equity and helps you invest. I think that the most underused resource in Australia is home equity, lazy equity. There's a lot of people out there. You're probably listening to me right now. You've got a property and you've had it for a number of years. It's probably gone up a little bit in value, but you've paid off a bit of the mortgage, and you've got equity sitting there. And the funny thing is, all these people with equity sitting there, what they're doing is they're getting up early. They get up early in the morning, have breakfast, walk past the lounge room, say hello to the equity, off to work for good 8, 9, 10 hours before they get back, because they've got to travel to work, and it's not easy for a lot of people. The 9 to 5, I've done it before, it sucks. I'm glad to get out of the grind. And really, if you're sick to death of your boss, if you want to tell your boss where to go, if you don't like doing what you're doing, you really need to make passive income through property your number one priority. Trust me, it was the best thing I ever did, because I really was unemployable because I didn't like working for people, especially dickheads, and I couldn't keep a job very long, really, because I didn't like being told what to do. So I ended up starting my own business, which is sometimes even worse because you're doing even longer hours, but at least you're doing it for yourself. But I was doing 80, 90 hours a week. It was very hard. So, business is not all roses. It's really tough. 70% of business close in the first 2 years, 90% close in the first 5 years. It's not easy. It's very tough out there for business owners. And, small to medium-sized businesses in Australia, they create 70% of our GDP. So you business owners out there, you're the ones employing people, paying the tax and helping Australia. So keep up the good work, because I know it's not easy. I've done it myself. You know what I mean? And But I got the freedom for property and got out, right? And part of the important part of that whole thing was buying right. How do you buy right? How do you know you're buying the right thing? You know, you really got to get your numbers right, get the demand supply ratio right. And basically what happens is you can get 29 different parameters, and we do them in every single suburb in Australia. There's about 16 suburbs. And then you can put them in a spreadsheet. This is what I do. And then I look at the numbers and it gives me a ratio. And then I only pick the ones that are right at the top, right? So what are over expensive and the cheap ones, cut it right down. So there's a lot of cutting and pruning until I get down to picking the 4 or 5 best suburbs in Australia to invest in. You know, this is a science. It's pretty amazing. And then once you've done that, then you know you're going to have growth, which is great. So then you can relax. Okay, you can buy this property and you can know you're going to have growth. That's easy. Next part is you've got to get the cash flow calculator right, which means you need to really put the numbers in and see, is it positive, is it negative, what is it? Because, you know, you shouldn't be emotional. You should say, okay, if the demand supply ratio is good and the cash flow calculator is good, this is the property I'm buying, right? Now, my method is buying a property that makes you money, buying a property that's going to cost you maximum $30, $40, $50 a week, but probably make you $50, $100, $200 a week. That's what you want, right? And I was talking to a client recently. He bought a property 2 years ago in Queensland through us, and he actually, his property's gone up 50 grand, and the rent's actually gone up $50 a week as well, which is pretty cool. So I'm pretty wrapped, and I want to interview him when he gets back because he's working in the mines at the moment. Yes, so once you've got those two numbers, that's what it works. That's the way to do it. So flying there and having a look doesn't really help, right, at all, to begin with. You can if you want after you do the numbers. The most important thing is the numbers. I mean, I buy all my properties without looking at them because I don't need to anymore. But when you first start out, it might make you feel uncomfortable to look at them. And that's what I did when I first started. But you've got to get those two numbers right. That's the important part, because that's the only way to substantially grow your portfolio without the stresses. Because the problem is, if you buy something with a big block of land, the larger the land portion, the less return you're getting. And therefore, the harder it is on your pocket, so the less properties you can buy, right? So you've got to look at your long-term goal and find out what you're looking at getting. And then you've got to find out, okay, how am I going to get there? And is this strategy going to work? So with my strategy, what you want to do is you want to buy 5, 10 properties in 10 years, each for around $20 or $30 a week. So if you can afford $20 or $30 a week, it's great. You've got to be making over $70,000 a year to do this and have a bit of a deposit or a house or a JV or something like that, or be really good at saving. And then you just work at it. And if you get 5 properties in 10 years, that's going to give you around about $125,000 a year passive income per year out of those properties, gross, not net, at the end of 10 years. And if you get 10 properties, that will get you $250,000 a year. When I did it, I got $180,000 because properties were cheaper then. Now they're more expensive, so you're making more, but it's just slightly harder. And, you know, a lot of people say, George, are properties too expensive now? What's going on? Well, no, they're not. How can I tell? I can tell by how much they cost per week. That's really the key. When you look at a property, and if you can get one for $20 a week, that's cheap, very cheap. They're not too expensive. If they cost you $500 a week, they're expensive. So that's how you can sort of tell as well. So let's say you go to Sydney CBD and buy an apartment there. It's going to cost you negative $300, $400, $500. So is that overpriced? Yes, it is. And I've been saying this for a long time now. Units, don't touch units no matter where they are. You know what I mean? Units, 9 times out of 10, units are a bad investment. They can be in certain circumstances, but it's a very, very fine line. You know, I prefer buying houses and townhouses because they've got a bit of a land portion to them, a bit of scarcity factor, but also you get good rent for them as well. And look, I know with units you can get high rent sometimes, but the capital growth's not there a lot of times, depending on where they are. They've got to be very boutique, so you look at boutique stuff. So look, that's my little rant about how to buy properties with massive cash flow. And what I want to do is I'm going to capital growth, not cash flow. I should really know what I'm doing about. How to buy properties with massive capital growth. That's how you got to do it. I know there's a lot here to learn. And what I do is I'm going to put some trainings together to give you some stuff. So come along to the Positive Property Club, which is now called Property Secrets. I'm going to put some trainings in there to help teach you how to get massive capital growth, because this is just one of those things where I need to share some data with you and show you exactly how I do it. So enjoy your Friday night. Thank you so much for being so patient with me. I'm going to go put my sunglasses back on and go watch a movie. Cheers. Bye-bye.